Financial crises are an inevitable part of venture investing, posing significant risks to portfolio companies. These crises can arise from numerous sources: market downturns, failed funding rounds, sudden revenue shortfalls, or operational mismanagement. For venture-backed startups designed for rapid scale rather than immediate profitability, financial discipline and effective cash flow management are crucial. Venture capitalists must proactively monitor portfolio companies to identify financial distress early. Key indicators include diminishing cash runway, missed revenue targets, increasing customer churn, reliance on a single revenue stream, or unsuccessful fundraising efforts. Vigilantly tracking these metrics enables investors to anticipate and address problems before they become existential threats. When financial trouble becomes apparent, swift action is critical. Investors should guide startups to extend their runway by immediately reducing unnecessary expenditures, deferring capital-intensive projects, and identifying quick revenue opportunities. Investors can support management by reinforcing fiscal discipline and, where appropriate, endorsing executive salary adjustments as a demonstration of commitment. Transparent, early communication between the startup and investors is essential. Founders should be encouraged to present clear, data-backed assessments and recovery plans outlining how investors can provide support, potentially through bridge financing or convertible notes. Early transparency preserves trust and creates a constructive path toward resolution. When traditional venture financing is unavailable, investors should assist startups in exploring alternative options such as revenue-based financing, venture debt, or strategic partnerships with larger enterprises. Though these options may involve less favorable terms, securing capital quickly can make the difference between survival and failure. Financial crises often demand strategic recalibration. Investors should support and encourage portfolio companies to critically reassess their business models, emphasizing profitability and sustainability. This may include pivoting, refocusing on core customers, or discontinuing unprofitable products or services, leading to leaner and more resilient operations. In severe financial distress, workforce reductions may be necessary. Investors should support management in handling layoffs transparently, compassionately, and decisively. Clear communication, adequate severance packages, and assistance with job transitions can mitigate reputational damage and maintain morale among remaining employees. Some of today's most successful companies nearly collapsed due to financial distress, but survived by making critical adjustments. Airbnb, Tesla, and Slack all faced moments where cash was running out, yet each managed to turn their crisis into an opportunity. For example, Airbnb struggled in 2008 when investors showed little interest, and the company was running out of funds. To generate cash, the founders resorted to selling novelty cereal boxes during the US election, a move that kept them afloat until they secured investor backing. More importantly, they refined their platform to build user trust, setting the stage for future success. Tesla was on the brink of bankruptcy in 2008, struggling to fund production of the Roadster. At the last minute, Elon Musk secured emergency financing, including personal investments, and the company shifted focus toward mass-market EVs. This strategic financial lifeline allowed Tesla to survive and eventually dominate the industry. Also, Slack, originally a gaming company, faced financial ruin when its product failed to gain traction. With dwindling cash, the team shut down the game and redirected resources toward their internal communication tool. That pivot turned Slack into a billion-dollar enterprise. For VCs, these cases underscore a vital lesson. Financial crises don't always mean failure. The ability to manage cash, secure last-minute funding, and adapt strategically can be the difference between collapse and long-term success. Investing in founders who can navigate these crises is crucial in venture capital. For venture capitalists, effectively managing financial crises within their portfolio can transform risk into opportunity. Early detection, decisive action, strategic adjustments, and transparent communication are fundamental to turning around distressed investments. Ultimately, it is the investor's proactive engagement and strategic oversight during crises that enable portfolio companies not only to survive, but to emerge stronger and better positioned for long-term growth.